Credit scores are a key factor in determining eligibility for loans and interest rates. They provide lenders with an assessment of a borrower's creditworthiness, which helps them decide whether to approve a loan and at what terms. If credit scores were abolished, lenders would need alternative methods to assess risk. Alternative methods for assessing borrowers. Without credit scores, lenders would likely look at other financial factors, such as income, employment stability, and assets. They might analyze spending habits, bank account balances, or even social factors like rent payment history. This could lead to a more personalized approach to lending, though it might also introduce bias. Potential for more inclusive lending practices. Abolishing credit scores could open up lending to a broader range of individuals, especially those with little or no credit history. People who have not used credit cards or loans could find it easier to qualify for financing, potentially improving access to credit for underrepresented groups in the financial system. Risks of subjectivity in lending decisions. Without the objectivity provided by credit scores, lending decisions might become more subjective. Lenders could make decisions based on assumptions or limited information, potentially leading to discrimination or inconsistency. Without standardized criteria, the risk of unfair lending practices could increase. The impact on interest rates and loan terms. Credit scores play a key role in determining the interest rates borrowers receive. If credit scores were abolished, interest rates might become less predictable. Lenders would have to create new models for setting rates, which could result in higher rates for some borrowers or make rates more dependent on individual circumstances. Increased risk for lenders without credit scores. For lenders, credit scores are a tool for minimizing risk by providing a snapshot of a borrower's likelihood of default. Without this system, lenders would have to rely on alternative data, which may not always be as reliable or as predictive. This could lead to higher default rates and less favorable loan conditions. Changes in consumer behavior and financial responsibility. If credit scores were abolished, consumers might place less emphasis on managing credit responsibly. Without the pressure to maintain a high credit score, people may not feel the need to prioritize paying down debt or avoiding late payments. This could lead to changes in financial habits and an overall shift in how people interact with credit. Impact on the credit reporting industry. The credit reporting industry, which currently tracks and analyzes consumer credit data, would likely see a significant shift. Without the need for credit scores, these companies could lose business, and new types of data analysis or reporting services might emerge to fill the void in assessing creditworthiness. Potential for new types of credit products. The absence of credit scores might pave the way for innovative financial products that assess borrowers differently. For example, lenders could offer loans based on income potential or asset ownership, and new types of credit-building products could emerge that help consumers demonstrate their reliability without relying on a credit score. Global impact of abolishing credit scores. The removal of credit scores could have broader implications for the global lending landscape. While some countries may adopt alternative credit assessment models, others may maintain credit scores, leading to differing standards of creditworthiness across borders. This could create new challenges for international lending and financial systems.